So what type of entity structure should we have for our business? The three most common types are LLC, C Corporation, and the almighty S Corporation. LLCs are typically good entities to have if you have some sort of real estate asset that you're making money on, or if you have a business that you're running. If you have a business entity that you're running, you typically want to have an LLC either when you're first starting a business or later down the line if you end up getting a partner part of your business. A common misconception with the LLC is that it actually saves you money on taxes. That is true to a degree because you don't have to pay any corporate taxes on any profits that the business makes. But in reality, an LLC doesn't do anything for you in terms of tax savings if you're an entrepreneur. They just give you asset protection in terms of separating your assets between business and personal. That's all an LLC does. For the most part, the LLC is not even a recognized entity by the IRS. It's just something that you have in a state so that the state can separate your business assets and your personal assets. A C Corporation is another entity, but a C Corporation typically only benefits big businesses. In order to be a publicly traded company and have your company's stock exchanged on the stock market, you have to be a C Corporation. So typically a C Corporation should be used if you have a big business. Another situation where a C Corporation may benefit you is if you have some sort of business model and you plan to sell the stock in your business down the line. A C Corporation could potentially benefit you in that situation. The big problem with a C Corporation is that you have two layers of taxation. You're double taxed. One, you have to pay corporate taxes, and two, you have to pay personal income taxes on the salary and dividends that you get from the C Corporation. The almighty S Corporation is a powerful tax savings entity classification for business owners who are profitable. For the vast majority of small to medium-sized businesses, some sort of S Corporation structure within your organizational chart will produce significant tax savings for you. The S Corporation saves you taxes in two ways. One, you don't have to pay any corporate taxes. For the majority of states, you have to pay some sort of state fee to have the S Corporation, but in terms of corporate taxes with the federal government, you don't pay anything, which is awesome compared to a C Corporation. And the second benefit of the S Corporation is how the owner compensates himself from the profits of the S Corporation business. The way you want to do this is you want to minimize the salary that you pay yourself. You only want to pay yourself a minimal, reasonable salary, and you want to maximize the dividends, the draws, also known as distributions of the profits from your business bank account to your personal account. So what does that mean? It means that you want to take a minimal, reasonable salary from your business and you want to maximize the transfers of the profits from your business account to your personal account. The best thing you can do in terms of really maximizing the S Corporation's tax benefits is to try to keep as much of the cash from the profits in the business and not take it out in the form of salary or distributions. An S Corporation can really make an impact in terms of the tax savings for a business owner when it's net profit. Remember that net profit is income minus expenses equals net profit, what is left over after all of the expenses have been accounted for, of $30,000 or more. For me, I personally don't think an S Corporation makes sense until you're making about $100,000. The correct entity structure could realistically be the difference between $25,000 in tax savings versus tax owed, all in relation to how you're structured as a business owner. If you'd like to discuss which entity is best for you, reach out to us.